I want to bring in Ren Leggi, portfolio manager at ARK Invest. Ren, thank you for joining us. Let's talk here first about the cash flow numbers, because once again, Tesla on the right side of the balance sheet.
Yes, thank you. Thanks for having me here. In our view, overall, we view at ARK, we view Tesla through a much different lens compared to traditional financial analysts. We're focused solely on disruptive innovation. And our analyst team are organized by cross-sector innovation themes.
Yep.
So we're covering Tesla from three angles, three different research analysts from three very unique perspectives. One being kind of electric vehicle and battery technology side. The other being artificial intelligence and through their full self-driving chip that they've vertically integrated. And then third, the autonomous kind of vehicle opportunity and the autonomous taxi network opportunity that we think Tesla is years ahead of competition.
So which one are you guys most excited about? Because you still got about another 5,700 points to go to your target. So tell me what the 20% move really applies to. What did you see this earnings that encourages your view?
Yeah, so some of the things that we saw, we are really focused on the autonomous opportunity. That's what's going to get us to our expectation and our target 5-year price target. And we don't see the market pricing in that opportunity for Tesla. What really excited us on the EV side, the cost, and this is no surprise to us, based on our research, we are looking at the cost decline associated with lithium ion and battery. So we were expecting the cost to decline, the overall cost for the Model 3, and it's no surprise to us that they came in with a cost that was estimated to be $2,000 below expectation. So we've seen a nice increase in their margin, which again is something we were expecting. And certainly to continue going forward, in our opinion. So
how then do you take sort of that, future expectations of the technology and the IP and balance it with still a company that, given the market cap, is basically around 400 times the earnings forecast for next year on a GAAP basis? I mean, is this a rally that's going to hold, do you think? This is important to you guys as fund managers right now, because we know that these shares have also had a lot of shorts, so I imagine that's probably part of the pop. Tell me what you think about the price action. Is it appropriate based on what we saw?
So, we are long-term investors. We're looking at these technologies and the impacts that, Tesla, what will Tesla be 5 years from now? So this short-term volatility, we use it to our advantage in our trading strategy. We're opportunistic traders, so we will trade around the positions in our portfolio. But as far as Tesla goes, we are really focused on kind of the competitive advantage that they have and their ability to kind of deliver, a lower-priced EV. And what we think within about 3 years, we think the price of EVs overall will drop below that of gas-powered vehicles. And so you're going to get a natural shift from the consumer base that's shifting to EVs. And we think, with Tesla's advantage on the battery side and their ability to produce these EVs at a lower cost than their competitors, they will be able to gain or at least maintain current, we believe, their market share.
Ren, about a year ago at this point, when we were looking at the cash flow turning positive for the first time, there were a lot of questions and a lot of bears saying that this company may not even be around in the same form in 5 years, much less a price target in the thousands. Are we now putting that behind us? Do you think these numbers and 2 quarters of cash flow positivity are now showing that the company will have enough runway to not need to go for more debt, to not need to go for M&A, to not need to try and take extreme measures?
Yes, we think in our models we were incorporating roughly $10 billion in additional capital that they would be raising. They've raised about a quarter of that so far. So we had not had concerns about cash. So The markets are open. And now that they are delivering above expectations on the delivery side of these vehicles, that is not a concern for us.
The SG&A costs were the lowest share of revenue in about a year. If you look at the numbers on CapEx, also were pretty solid in terms of helping that margin. As they want to ramp up the China plant, as they want to start building SUVs, will that margin stay intact? Can they do the types of personnel cuts and stretching on the middle part of their business, that margin that they did in these past couple quarters?
Yep. So think about electric vehicles. This is a totally different technology compared to gas-powered vehicles, which is a very mature technology. If you think about it, we've been manufacturing them for over 100 years. So I think people are viewing it. Putting Tesla as in the category of these traditional auto manufacturers, where their core competencies are on the gas-powered. Tesla is really creating something completely different.
Right, but they still, if I could just jump in, Ren, real quick, sorry, because we're running out of time. If I could just jump in, gas or no gas, this is still a company that really brought down expenses for their employees. We know that they went through periods where Elon was sleeping on the floor, and they talked about having people work extra hours. So the cuts that they made for SG&A costs, the lowest share of the revenue that it made up, also the CapEx side, is that sustainable?
Yes, I mean, going forward and where we believe EV sales will be in the next 5 years, that will support this. Again, this is a longer term view. Okay,
so what will you expect in terms of their spending going forward as they try to ramp up new production? Because they want Model Y too, and I mean, are they going to be able? Are we seeing from the product mix and from the money coming in from the sales that they'll be able to, if they need to, bring up hiring or spend a little bit more? Or is it still a thin margin?
I mean, where you're going to see the savings is really coming on the cost to produce. That's what we're focused on from a technology standpoint, and the battery costs associated. The cost, again, for lithium ion and the cylindrical cell batteries, the cost curve is bending downward, and we anticipate that cost will continue to drive downwards. And that's where you'll see that either their margins increase or they start to drop the cost of the vehicles.
Yeah, okay.
To become more competitive and gain market share.
Okay, Ren, really good stuff. Always fun chatting with you guys. Looking forward to next time. Appreciate it. Ren Leggi joining us, portfolio manager at ARK Invest.
Thank you.
We'll be right back.
Take care.
Thank you, sir.